I'd be a little cautious on a bounce. I mean, we've only seen about 0.8 of one multiple point of compression, and a lot of the issues that had pressured the market are still present. The administration has a lot of incentives to press China a little harder because there's so much that China could do on trade, on Iran, on North Korea. A lot of levers they can pull. Also, the Fed is not going to be shaken off their rate hiking course. And when you look at the Treasury yielding 3% or better, that's pretty competitive with the forward 10-year return of equities. So I think there's a little more to go, and I would be fairly cautious in this volatile topping process.
You got 2/3 of the S&P, Barry, down 10%. I mean, when do things get interesting for you?
Through the course of the G20 in Buenos Aires, when possibly Trump and Xi will meet, you might see some sort of progress made in a very tumultuous period up until that time on the trade front. We'll also know about the December rate hike and what the indications are for 2019, and that could also be a positive catalyst. So there could be more pressure between now and then, but it does feel like this normalization of interest rates and yields has some pressure on the PE multiple of the S&P.
Ghadir, for the past week or so, we've had quite a number of experts on our air saying this is it. This is the great rotation starting from growth to value. Do you agree? And if so, is that something that can power this market higher through the end of the year?
That's a very interesting question, actually. In our way of approaching equity markets and equity valuations, we look for companies that have growth, that are attractively valued, regardless whether you call it a sector rotation or a style rotation, etc. So what we look for, and we will continue to look for through this volatility, are companies that will give you that sort of growth where we actually think that stock markets follow at reasonable valuation. Remember, companies can be called value and growth in different parts of different times of the market.
Barry, what's the lesson for investors from this pullback, would you say, in terms of the role that tech stocks are going to play going forward as we hit air pockets, perhaps as we continue to see the sell-offs and the market's finding its way? What should investors expect based on what we've seen over the past few days?
I guess the lesson is be careful.
Sorry, that was for Barry.
Yeah, I guess the lesson is to be careful what you wish for, because the normalization of interest rates and yields is going to bring the PE multiples down and make bonds a lot more attractive versus stocks. We also have an environment where the Fed backstop essentially in very tax-incented companies that have very low yields and spreads on their debt, and that can only go up from here. It really can't go down. So the lesson is if things get normal, the cost of money goes up, and it's harder to make money in the stock market at a more reasonable multiple than what we've had recently.
Ghadir, obviously, Barry weighed in briefly there on the trajectory of rate hikes, but do you believe in the Fed's ability to withstand criticism from the president? And if they do decide to pause, we've been asking guests this morning, how do you do that in a manner that doesn't make it look like you're beholden to the executive branch?
I think the Fed will absolutely be wanting to talk about themselves as completely independent and wanting to do whatever is right for the economy going forward. So if they are responding to economic data, then whatever they do will be construed by the market as them actually either normalizing rates or looking to contain possibly any inflation that might come in the future. I think the Fed will stay the course, and I think it's the right thing to do in order to have some powder dry further on if we do have some weakness in the economies as economic growth cycle actually matures.